What are the markets looking like? If you look at some of your competitors, and overall, it just seems that the market volatility has hurt some, especially in wealth management. What does it mean for you?
Look, it's been a difficult Q4. I mean, you can see the result of our peers who have announced volatile markets, although things have gotten better since the beginning of the year. 2019 has started better. For us, it vindicates everything we've been doing for 3 years, i.e. reduce the costs so that we can handle the decreases in revenue, cut the risk very significantly, which served us well in Q4. I mean, in Q4 15 was very, very different for us. A very structured bank has weathered this, and we were really pleased to announce a buyback early this year, which started January 14th, because it's a vote of confidence in the company by regulators. That buyback was approved by regulators. It means that we've dealt with our major legacy issues, and there's no big cloud hanging over Credit Suisse. If we're returning at least $1 billion to shareholders this year, in this context, it's very significant, and we're very pleased.
But are you worried about client outflows because of market volatility?
We've seen deleveraging. It was visible a bit in Q3 and Q4, but overall, our assets under management have been very resilient. We talked about it at Investor Day. We just updated the market a few weeks ago, and nothing material has changed compared to that update. We gave a very detailed guidance on Q4, and if there was any deviation, significant deviation, we'd have to tell the market, and that's not the case. So,
how can you compete with, for example, the likes of Blackrock when it comes to institutional investors?
We're not really competing with them. Our strategy is really focused on wealth management and ultra-high net worth, where we've made really excellent progress, been able to attract very significant flows. The lending strategy that we started a few years ago has been very successful, and that actually contributes a lot to the resilience of the assets, because it makes the asset more sticky. And the fact that we have this global relationship with our clients, where we provide both investment banking and wealth management, has proven actually quite a strength in these difficult markets.
So looking back at the markets, you're expecting a little bit more tempered markets in the first quarter. That's what you saw at the beginning of the year. What about the next?
It's too early to
12
tell.
months?
I mean, really, I think the one conclusion we can draw from the last 12 months is that any forecast is very, very tricky to make. This is why we've taken a very cautious stance. We're positioned defensively, low cost, low risk, flexibility, so we can pick up on any upside should a trade agreement be reached between China and the US. Will be ready to benefit from that, but we're also, with a strong capital base, a rebuilt balance sheet, we can also deal with a downturn.
What's the biggest risk to 2019? So you mentioned there are the trade talks between the US and China, you have Brexit, you have a slowing European Union.
I'm afraid to say it's politics. Running a country has become a more challenging job than ever before. There's been a lot of thinking on how business would be disrupted by technology. Impact of technology on business by sector. I am not certain that there's been the same level of thinking about how politics would be disrupted by technology. And the examples are many. We see them around us. And this is a new world. We all have to adjust to.
So do you think governments ultimately are the real obstacle to world growth?
I wouldn't call them obstacles, that would be rude, but I would say that political uncertainty certainly doesn't make our job as business leaders easier. There are a few things I think many of us believe in: free trade, stable policy frameworks, pro-business policies, because I believe in the long term that's the best way to generate growth and actually help the more vulnerable portions of a population. Some of the policies that are being advocated are possibly seductive in the short term, but have very significant long-term implications.
When you look at the economies of Asia, you've always been optimistic. Is there a concern that actually, as China has to stimulate inwards, they leave out some of the stimulus that they can give to their neighbors?
China has been very explicit. If you look at the last plenum of the Communist Party, the slowdown in growth is in the official documents of the Communist Party. From 3-4 years ago, they explained that they were going to transition from an export-led, infrastructure-intensive model to a more consumer-oriented model, how it was important to reform the welfare system so that the saving rates go down, because there's the pension system is not what it should be, and the healthcare system is not what it should be. If you look inside the Chinese economy, you see that the healthcare sector is booming. So the average of 6 is a mix of the old Chinese economy, which is possibly stagnant or retrenching, and very new, very dynamic sectors which are supported by the consumer. And that's the secret of long-term growth, because you want a kind of endogenous consumer-driven growth, which is what the US has, and it serves the US very well. And the Chinese economy is moving in that direction. So long-term, we're not worried. Short-term, for us, we've seen most of the slowdowns in Asia as opportunities. Historically, there have been opportunities for us to take advantage of the fact that others maybe get scared or withdraw. We try to drive a continuous, not a stop-and-go strategy, a continuous strategy which over the long term has served us very well.
What's client sentiment like overall? Is it different in Asia to what it's like in the US? How many
it's
people
been variable. What I observed in Q3, Q4, I was in China in September, in Japan, and it was that the sentiment was very negative. One of my clients, when I asked him about sentiment, said awful. So we kind of felt that coming. I think there is now actually paradoxically an improvement. As you see the numbers,
Why?
Well, a lot of indicators are lagging indicators. Well, the sentiment is a leading indicator. So you see sentiment turning negative before the numbers turn negative, and now you can see sentiment stabilizing before the numbers stabilize. So that's what's going on.
Okay, what will happen with Brexit?
I was hoping you wouldn't ask me about that, but
there's no chance.
I'm an optimist. No, look, I've said, I think to you on the record, that I believed it was in the long-term interest of the UK to stay in the EU. That was before the referendum. But I'm a Democrat. The referendum has happened, and the UK has made the decision. We know it's now up to the political leadership in the UK to manage this. As a company, all we can do is prepare for what we consider the worst, which is a hard Brexit. And we have been working very hard to be ready for March 29th.
But are your clients ready for it? How many questions do you get on Brexit a day?
It depends. More in the last weeks, people are concerned. All we can do is help them manage through this, and always be there for our clients. This is when having a strong balance sheet, having the capital to support them is crucial.
What do you need to make your life easier in 2019? Is it support from shareholders? Is it support from regulators? Is it support from governments?
Look, 19 is a very important year for us because it's our first quote-unquote clean year. We're out of a restructuring. We don't have restructuring costs to bear anymore. We've refunded our most expensive funding, the COCOs we had at 9.5%, so we had a huge tailwind from that. And we don't have the restructuring unit anymore, which has been closed, so we don't have to bear the cost of eliminating those unwanted assets. So those three factors are a big tailwind for Credit Suisse, and we're really focused on serving our clients, and we're really pleased to be out of a restructuring, and we're really pleased to do a buyback so that we can now start returning capital to our shareholders rather than asking them for capital. Yeah,
and we're going to see a chief executive that wants to grow the bank, right?
Absolutely.
Has anything changed from Investor Day on your strategy?
No. It's the same. Focus on wealth management. Take advantage of the long-term growth opportunities. Be steady. I believe there's one thing we've been for the last 3 years is consistent. We come back year after year, boringly telling you the same story. Story hasn't changed. Our slides are the same. We just add a little bar every quarter, and we're leading the same strategy. World wealth is increasing. It's a huge opportunity, and we're very well positioned to take advantage of it. I
mean, I'm consistent because I feel like every January I ask you, is this a year where we're going to see European banking consolidation?
And every year I tell you no, and so far I've been right.
But this year, it's not. There's no appetite for regulators.
The appetite is there.
From
but
who?
the obstacles,
Chief executives or regulators?
I think from everybody in Europe, because everybody sees that we're not necessarily less good at banking than people in other parts of the world. So if the results are less good, maybe it's because of environmental and structural factors. We work as hard, and I believe we understand finance as well. So people see that there are structural impediments to a better performance of banks in Europe, but those are very difficult to address from the notion that banks shouldn't get any bigger. So how to consolidate if people think that banks are already too big. So there are political issues there. And then there is the regulation, which needs, as you know, to consolidate at the European level, so that from bankruptcy laws to the capital requirements, until we have a more level playing field, it's going to be very difficult to have cross-border consolidation. I have to say, in-market consolidation remains, I think, an opportunity and necessary.
Okay, but do we need, so in-market first to then go cross-border? And what's the catalyst?
I'm not sure it's a question for me, but our strategy has been very clear to focus on Switzerland, which is sometimes I say certainly one of the best managed economies in the world, with 42% debt to GDP ratio, and where we do very well, and then project ourselves in the parts of the world where there are profitable growth opportunities, and that's mostly emerging markets, and that kind of strategy has worked well for us.
Okay, the emerging markets, final question. How much is it linked to monetary policy of the US? So you actually need a weaker dollar?
There's clearly a correlation. I had warned a few years ago against US dollar debt, drawn by very low interest rates, cyclically low interest rates. So that's coming back now to create a few issues. But again, the long-term trends of demography, of technology, of growth of a middle class, we believe mean that emerging markets are still a long-term opportunity.